S. Subramanian, the CFO of Titan Company. Good morning, Mr. Subramanian. Thank you very much for joining us. Well, first let me get one issue out of the way, the gold monetization scheme. Is that going to make life any easier for you? I mean, we don't have the details. I think those who put their money, put their gold in the deposits, in the gold deposits, will get about 3%. Will the gold available to you come in any cheaper, lease gold?
Well, I really hope that this works because as you know, we've had this situation 2 years back when the CAD situation was out of control and the government had to curb on the imports substantially, and that is something which makes it very difficult for the jewelry industry to operate if gold is not available freely. We would require maybe 500 to 600 tons for the jewelry part, and a lack of supply would be an issue for us. Having said that, we generally have been recycling gold to the extent of around 20-25% of our requirements. This is without the gold monetization or gold deposit scheme as they were running earlier. And therefore, it is not that we are not recycling our gold, but it would be helpful really if we can get more gold, as we keep estimating 20,000 plus tons of gold lying in our homes. If that were to be monetized, it would really be helpful for all of us. So even 10-15% of that gold coming out would be a very substantial quantity. It could possibly ease the situation for at least the next 3 to 4 years as such, at least as far as the jewelry industry is concerned. The investment part is a very different angle, and that's something I think the government might want to regulate, if at all, at some point in time if the CAD situation worsens. But as of now, we think it's fine, and we are hoping that the monetization scheme works well. It's good for the industry as a whole.
Oops, okay, there's some issue with the video there. We'll just come to you in just a bit, Mr. Subramanian. Just watch out for the market as well, because now the market is moving to the lowest point of trade. The Bank Nifty is down almost about 0.5% now, and the Nifty is slowly and steadily grinding towards that 7,800 level. Couple of heavyweights like ONGC are exerting pressure on the market. L&T and Reliance are also exerting pressure. So these three heavyweights are down anywhere between 1 to 2%. In any case, the capital goods space has been under a cloud for the last many days. There was quite a bit of delivery-based selling as well. So both L&T and BHEL are now down about 1 to 1.5% apiece. But let's resume our conversation with Mr. Subramanian. Mr. Subramanian, morning. Your stock has been under intense pressure. In fact, as we speak, it's sitting at a fresh 52-week low. And the worry is that for some of these companies like yours, there seems to be no pickup in overall demand. That was the caution that you had alluded to the last time as well. Since the last time we spoke, has there been any revival in demand at all?
We've seen a fairly better quarter. I would say July was a much better month, and I think we've reported that even during our earnings call. The drop in gold prices which happened around June helped revive the industry a little. So there was a reasonable surge in the month of July. Of course, it's come down to normalcy now, but I think we are seeing a quarter which is slightly better than the previous ones for sure. That I think is a given. But having said that, I think in our own case, because of our golden harvest background and the fact that we had it last year, we had to redeem it, and this quarter is definitely going to be a significant negative. I mean, that's a given. You can't have a growth over a 60% growth that we showed last year. So we will be under pressure this quarter, but I think going forward from the next quarter onwards, we expect to show decent gains, growth over the previous year. So
can you get the first smell
we are also hoping that,
Can you get the first smell of festival demand? Will it be better than last year? Comparing like to
early to say. Yeah, a little early to say, but possibly yes. One has to wait for maybe another 15-20 days for that to really see, but we've at least seen demand slightly better than what it was in the past.
When you say July was a better month and you're expecting things to get a bit better, how do you quantify that in the watches segment? Because over there, your revenue growth has been hardly about 10%. Your margins have actually been falling. So what kind of growth do you expect in the watches segment, and how well is the premium side of watches doing?
On the growth side, watches will be under pressure because of the general mood. Consumption is not something which has picked up significantly. That's a given. Watches as a category, as we keep saying, is more on the accessory space than the utility space at this point in time, and therefore it does get a backseat. It does get hit when consumption demand is fairly low. Having said that, I think one phenomenon we have been seeing of late is that higher priced watches seem to be doing better than the lower priced ones. So the premiumization journey that we undertook a year and a half back on the Titan brand seems to be paying off. So that's a good sign. We are seeing people willing to pay more for watches. So the average watch price seems to be inching up. Yeah.
Okay, will that mean that in the fullness of time your margins are going to improve? When I say fullness, I mean by the fourth quarter?
Early to say that, but it's a good sign. It's a good sign going forward, but obviously watches with higher prices tend to have better margins. So one is expecting that to improve over a period of time. But I think more important, it's about the overall growth. The operating leverage is where the issue has been. With growth being subdued at sub 10%, double digit, we've been challenged because inflation is taking cost up and so on and so forth. So if we start growing on the top line, I think our margins will improve substantially.
Can you give us a sense of what's happening in terms of, demand as far as walk-ins are concerned? Because we've seen an onslaught of all these e-commerce shopping, the discounts that you get online, etc., and that has reduced the number of walk-ins. Are you facing a reduction as well? And will that lead to lower number of store additions from Titan's end, say in the next 3 to 6 months?
Walk-ins have been challenging. Yes, that's a fact. I think across the board, whether it's in malls or high street, etc., it has been a little challenging. So I don't think that trend has changed much. How much it has to do actually with e-commerce, one is not sure. We keep talking of this concept of snacking and so on and so forth, where people tend to buy smaller items over a period of time more frequently, and therefore maybe some of the larger ticket purchases are getting impacted. But these are just theories at this point in time, not fully vetted. So walk-ins have been challenging. I think that's clearly a given. How do we think it's going to improve? I think, as I said, one is hopeful that the festive season, the last 2 years have not been very good.
No, my question was more to do with net store additions. I think in Q1 you added
I
about
don't think,
22.
no, we are not changing our plans. We are not changing our plans as far as net store addition is concerned. We believe in the long-term India story. We believe we are poised for very good growth. We would have these few quarters where there could be the ups and downs, but the long-term story is very, very intact, and we will continue to invest significantly in network expansion.
I guess walk-ins are jacked more by parking problems and traffic issues. I'm not so sure about the digital angle yet. But Mr. Subramanian, on the new store additions, my question was more whether, you're going to break even faster simply because I guess commercial space is a tad cheaper than when you made your plans. So will you break even faster?
You are right. Actually, real estate is softer now, and that is something which could help in expanding or locking in prices for a longer term. So you are right. But having said that, most of these stores now that we would be going in for would be franchisee stores. So there'd be very few company stores really, and therefore the cost or the benefit for that matter goes entirely to the franchisee. So which is good. It makes it more attractive. It's good for us to get franchises easily.
Oh, right.
So yeah.
Okay, Mr. Subramanian, we'll leave it at that. Pleasure speaking with you. Thank you very much, and hope you have a good festival season selling more jewelry and watches.